and welcome to Business Today. I'm Siddharth Zarabi, and joining me now is Mr. Neelkanth Mishra, the Chief Economist at Axis Bank and a member of the Prime Minister's Economic Advisory Council. He joins us hours after the economic survey for 2025-2026 was presented in Parliament, and that survey, the longest on record so far, almost 800 pages long, captures and provides us a sense of the Indian economy and also glimpses into what can be expected in the future. But my guest, one of India's most noted economists on the show, is someone who understands both the fine print and the larger macro picture of the Indian economy. And as I welcome you on the show, Neelkanth Mishra, I want to begin by asking you to share with our viewers the top couple of points that you picked up from the survey with regard to what can be expected, because Prime Minister Modi sort of set the agenda in his initial remarks at the opening of the Parliament session that the reforms express will continue.
No, thank you, Siddharth, for being here. As you rightly said, the 736 pager, it's just been a few hours. Even with the help of as many chatbots as you can find, there's only so much summarization and gist that you can capture. So there's a lot to go through. I think Anand and his team have put together a fascinating and very rich set of analysis. The key takeaways for me, I think, as a market economist, the first is that that 6.8 to 7.2% growth for FY27. This I think sets the stage for, not that this means this is what the budget will be assuming in terms of nominal GDP growth. I think 7% type of real growth and a 10.5% nominal growth assumption in the budget then appears credible. I mean, it will not be fairly largely disconnected from this. I think he very rightly raises the point that India needs to respond to a number of changes that are happening globally in terms of disbelief of, or rather reducing belief in open trade, free trade, increasing protectionism, slowing global capital flows, rising global cost of capital, and all the challenges and how we should respond to that. So I think some very fascinating recommendations like eventually targeting a 6% of GDP of general government deficit is absolutely the right thing to recommend. But given where we are, I think it means that there needs to be more fiscal consolidation. Very rightly, there's a whole chapter on urbanization, which I think is one of India's biggest challenges. On certain measures of urbanization, the urban population in India is actually larger than that in China. This is something that warrants, I think, thought at the general government levels, not just central government, but state government. He very rightly talks about the energy transition, the importance and the exciting things that are happening in the survey or in the services sector in India. So there's a lot to go through, but all in all, I think very, very powerful set of analysis. And unlike some of the surveys that we have seen in the past, perhaps which were disconnected from the budget making process, given the stature that Anand carries in the government and what we have seen in the past, some of the comments made in the survey, for example, where earlier he talked about, instead of importing things from China, why not get the Chinese to set up factories in India? And we've seen that the government has started moving in that direction. I think a lot of the analysis that we see needs to be taken very seriously as potential directions in which the government may move.
That's a very important point that you make, and I'm reminded of previous comments about China that have been made in the past, and that's we'll have to wait and watch for what happens. The last year's survey gave us a sense of a reform yatra, and you spoke about potential directions. Would you be able to elaborate on, let's say, what seems to you to be the lowest hanging fruit that the survey indicates that should be addressed in the upcoming budget?
Look, I think for your viewers and for all of us, it is important to understand that the writing of the economic survey and the preparation of the budget are generally not synchronized developments. So the teams that work on the two are separate teams, and therefore, just because something is mentioned in the economic survey does not mean it will increase the likelihood of that change happening in the budget. In fact, even on the reform agenda, and I totally agree with your assessment, and what of course our expectation also is that the momentum on reforms, and even in the budget, I expect that the fiscal numbers are very hard to move around, given that the government is very firmly moving in the direction of its promise that it will get debt to GDP down at a central level to 50% by FY31, which means that the fiscal deficit has to shrink. There is a pay commission coming next year. There will be arrears which have started accumulating on the pay hikes starting 1st Jan this year itself. And therefore, as if you're targeting a debt to GDP of 50% in FY31, and you know that next year you may not be able to consolidate, you have to do quite a bit this year. So on the fiscal numbers, I don't think there is a lot of scope. A few things, and maybe I'm primed for that because I expect the government, or I would like the government to do more, which is, credit guarantee schemes for MSMEs. So I saw these very interesting charts on how credit to MSMEs has been expanding significantly. And given how successful the last credit guarantee scheme was, the ECLGS, where at a potential cost of 18,000 crores, the government was able to get about 7 lakh crores of credit to MSMEs. Clearly, the credit guarantee schemes, which used to earlier create a lot of moral hazard, are no longer doing so. Maybe because there is a lot of private sector involvement now, and therefore the use of ECLGS or credit guarantee schemes has been much better. So maybe that's one direct clue that we can take. But beyond that, I would say that the importance on, say, deregulation that Anant and his economic survey also talked about the last 2 years, and how it hurts the MSMEs the most. And given that the Rajiv Gauba committee is giving a series of recommendations, and they continue to give recommendations, and every month there seem to be something that the government is acting on, and the Prime Minister's confirmation that they will continue to work on that is very exciting. And it is quite possible that outside of the budget numbers, maybe the budget speech incorporates some of the more recent suggestions from the Gauba committee, and we could see those announcements in the budget speech.
Absolutely. And clearly, the good news picture that is painted in the survey, and the Goldilocks moment for India's economy, as many observers call it, is well appreciated and captured. I want to focus on one of the challenges, Mr. Mishra, that have been spoken about, and this is the weakening rupee and the consequences for imported inflation. Has a point been reached where the depreciation of the rupee now poses a question that policymakers will have to answer, that how much more can you sort of draw down on your reserves, because there is ultimately a trade-off that is witnessed in such situations?
Look, the inflation in India, and the fact that there is a record low inflation in India, and on some of the more broad-based indicators of inflation as well, the reading is at very low levels. It suggests slack in the economy, and most of the time the slack is in the labor market. So imported inflation, say, what we have seen is a very sharp increase in steel prices over the past 3-4 weeks, but that's primarily because, for reasons I can't understand, the government gave more protection to the Indian steel industry, so prices are up some 6,000 to 8,000 rupees a ton. Globally, of course, copper, aluminium, zinc prices are going up, but the But those do not directly, I think, impact a very large part of inflation in India. In fact, China continues to pressure down many of the manufactured goods, and I think the labor market in India still carries a lot of slack. So policymakers shouldn't have to worry too much about inflation or imported inflation when they're looking at India's headline numbers. And in fact, if that 1.5%, 2% or 2.5%, 3%, if that goes up by 20, 30 basis points, I don't think that will be particularly negative or be concerning. In fact, maybe slightly positive. On the currency itself, I think the steady pressure that we have seen is very temporary in nature. It's an adjustment process to what was possibly a policy error when the USD INR was effectively pegged at 83. So when you try to peg the currency of a current account deficit country, eventually when the peg breaks, it does a lot of damage. And so in the October-December 24 quarter, the Reserve Bank therefore had to intervene by $60 billion in the spot market, $90 billion in the forward market. The $60 billion and the 5 lakh crores of liquidity they drained was replenished over the course of 2025. But the overhang of the $90 billion of short positions in the forward market was something that is something that still remains, meaning there's $50-60 billion still remaining. And that, I think, just remains an overhang on the rupee. One of the things that happened when the USD INR was effectively pegged was that people stopped hedging. So when you have when you have, say, $950 billion of goods and services imports, if your hedging ratio drops by even 10%, so even if 10% of importers stop hedging, there is a $95 billion swing. So maybe the increase in reserves from 600 to 700 was driven just by the fact that some people thought they didn't need to hedge. And so eventually when they came back to hedge, and it created a pressure which was surprising to most people.
Right.
Because the balance of payment perspective, because the current account deficit, as the survey also says, is very manageable. Foreign direct investments are actually picking up. There is some increase in FDI repatriation, which is actually the circling of dollars, which I think will come back in as well. So on a runtime basis, there is not much pressure on the balance of payments. So the incessant demand or excess demand for dollars seem to be companies and other participants in FX markets perhaps increasing their hedging positions. And so this is, of course, by nature temporary. At some point it will go away. But when we think about our reserves position, maybe it is prudent to think about a much lower level of reserves, because the $600 to $700 billion increase seems to have happened just because some people have stopped hedging. So now that they've gone back to hedge, it seems like there is a lot of pressure on the rupee. So I don't see this as a structural problem, but it does need a fix, and perhaps we will discover that fix sooner than later.
Good point. They're very comprehensive, and I take note of the last words, that not a structural issue really. One quick comment. The overcapacity in the Chinese economy, and I'm trying to tie it to a much larger approach towards customs duties, because that is the third part of what we have already seen in terms of direct, indirect tax, and now tariff changes. Should policymakers be worried about Chinese overcapacity and the likely consequences in the months ahead?
And especially as increasingly, and I think now that the US has blocked Chinese imports, of course there is transshipment and all of that happening, but there's also a trade diversion happening, meaning that instead of dumping in the US, the Chinese are dumping in Africa. They're finding opportunities to dump in Southeast Asia. Mexico, you must have seen, has already raised import tariffs. So we have to selectively remember that On intermediate goods, so we have to be very careful in thinking through where to put the barriers up and where not to. And there will be intermediate goods where if you make yourself too expensive domestically, and it is not critical for self-sufficiency, and where say something as simple as steel, right? So there is adequate steel capacity in India. It's not that Indian firms are not profitable or Indian firms cannot make steel. The downstream industries, I think, definitely need then get affected if the cost of the intermediate good is actually going up. So we have to be very nuanced and careful in what types of protection we provide. But my apprehension is that all of this talk of China starting to balance its economy, boost consumption, is not very doable. In fact, most of our research shows that the Chinese, despite of shrinking labor force, Chinese labor force participation rates are falling, real wage growth is low, they cannot raise their retirement age. A large part of household wealth is actually in real estate, which is falling in value. So consumption in China is not going to rise well, and industrial capacity expansion continues to happen. So the $1.2 trillion of surplus, which has shocked many people, is just the beginning. I think it is going to become much bigger in the next 3 to 5 years. And as policymakers, I think in India, we need to be aware that this disruption is happening. Which are the sectors where we need to protect? Which are the sectors where we can take advantage of the Chinese overcapacity and build the strengths of our own? So I think that's but policymakers definitely need to take note and respond to this.
I'm glad you've given those details. I want to follow up by asking you that in terms of the single largest challenge that you see for this Goldilocks phase, and this is a journalistic way of describing a very, very complex economic situation, is geopolitics the single largest challenge in the medium term? And how do you see our trade-related responses and some of the successes in the recent past helping us mitigate that to whatever extent?
So I'll split the response into two parts. Is geopolitics our biggest challenge? I don't think so. I think our biggest challenge is all domestic. Our biggest challenge, and I think the Honorable Prime Minister has cottoned on to it, it is about just deregulation, improving supply, removing supply bottlenecks. For example, urbanization. I think the economic survey, by highlighting the importance and the needs to get urbanization right. For example, in most economies, a large part of capital stock is real estate, commercial and residential. If we don't unlock the supply in that, very quickly the demand for real estate results in sharp increases in prices, and that ends the cycle. If we want to sustain this construction of good quality offices, good quality residences, it creates jobs, it creates demand for materials, and of course improves quality of life and efficiency. All of that to be sustained for 15, 20 years requires sustained development, improvement or investments in urban infrastructure, in the pace at which products get approved. So all of these are very domestic challenges. We have learned how to do connections between urban centers, but we haven't yet figured out at a scalable level. So some of the cities, I think, are doing it better than others. But for 500 to 1,000 towns and cities in India, can we really solve the urban infrastructure problem? There are challenges that exist in terms of the pace at which new businesses can ramp up, the energy prices, the cross-subsidization that is still a huge problem, that we overcharge industry and services and we undercharge farmers and households. I think some of those things are much, much more important than anything that geopolitics can shape. And in fact, very rightly, what the survey also highlights is that at a time of disruption like this, what you need to focus on is domestic strengths. And strengthen yourself domestically, focus on the right reforms. So all of this is extremely important and has to be a priority. If we do this right, I think geopolitics can do what it wants. We will be fine. At the same time, when you're changing, when you're seeing these changes, I think the alliances, the need for technology, as we grow our electronics ecosystem, it needs to have a blend of technology partnership with Europe and with US. And given that such a large part of the value chain now lies in China, we need to have trade linkages, maybe joint ventures with Chinese companies. In energy ecosystem, we need to have to get competitive battery prices, to get competitive electric vehicles. There's so much that needs to happen in terms of technology partnership and attraction of capital, that we do need to take geopolitics seriously and make sure that our broader strategic interests are not compromised. And in that, I think the government, especially the recent EU FTA, I know a lot of positive things have been written about it. I just want to add to that by signing this, I think India has signaled that it stands for trade openness, that there is an advantage it sees in free trade, and that it stands for it. And so I think these kind of measures can counterbalance some of the disruptions that are happening.
As we wrap up the conversation, Neelkanth Mishra, I want to pick up a couple of points quickly with you. One, in terms of capital flows, what can swing the pendulum? Is it a policy response, or is it, frankly, the US trade deal where we have made whatever we could and we are now waiting for the Americans to make up their mind, even as we have moved ahead with the EU? What is it that you think can be the pivotal point for a broader reversal in the capital flow trends that are bothering some of us?
So, my apologies, but there's no straightforward answer to this. So I'll split it into a few parts. I'll take a few minutes. So see, there is foreign direct investment. So capital flows have three major parts. So there is direct investment, there is portfolio investment, there is debt flows, external commercial borrowings, banking capital, NRI deposits and all that. So ECB's NRI deposits are, I think, happening fine. I think there is adequate flow there. I think the issues have been in FDI and FPI. In FDI, the foreign direct investment, the gross inbound FDI is actually not too bad. In fact, it's rising, and we are seeing increasing commitment. So companies who have strategic intent, who are investing for the long term, are actually showing their intent by putting in big dollars into India. So in financial markets, investments in banks, investments in non-banking finance companies, investment in brokers. So large Japanese, West Asian strategic investors, as well as private equity investors, are making big bets. So gross inbound FDI is not a problem. The FDI repatriation, which is when someone has already invested, they sell and they take their money out after a while. So given that a reasonable part of our FDI after 2012-13, 14-15 was private equity venture capital, it has now, that 8-10 period, because those funds only have an 8-10 period life, 8-10 year life, they now need to give back money back. So they're selling themselves, they're selling their stakes and in the stock market, which is holding up, and then taking that money back. So FDI repatriation has gone from 20 billion a year to 50 billion a year. Now, so that has been a big drag, but most of these firms which are getting exits are now therefore doubling down on India, because they're seeing that this market needs that capital that gives good returns, and it is free to enter, free to exit. So they don't have China type problems here. And therefore, the likelihood that they come back and the inbound FDI goes up. So FDI is picking up. I think that maybe, in my view at least, the worst is past. Portfolio investments is where I think the uncertainty is still quite large. One of the biggest problems is that a very large part of the portfolio investments in India happen through emerging market funds and Asia funds. And those funds are, by and large, not seeing significant inflows. In fact, if you see what has happened, for example, in Indonesia or Russia or Turkey or South Africa or Argentina, it is very clear that there is significant disruption. There are many funds where the LPs, or basically the people who invest in those, allocate money to those funds, are now demanding that you create a fund which is ex-China because there are geopolitical reasons. So the EMs as an asset class has been struggling. Within that, the limited funds that do exist in EMs, and last year EMs did a bit better than the US, so maybe they'll start seeing some inflows now. But within EMs, India has been lagging because we had slowed down. That is, of course, reversing now. But even as we pick up pace of growth, the semiconductor cycle has turned, and semiconductor prices are going up, memory prices have shot up. So people are saying that whatever 12-14% growth that you can offer, or India offers over the next 12 months on earnings, can be achieved in a month because the semiconductor prices are going up, and some of the largest semiconductor companies in Taiwan and Korea can give better returns. So that's the tactical nature of what's happening. So maybe it takes a few months before that upcycle ends, and then India then becomes. So I don't think it's about the US deal at all. I think the US deal, given that impact on trade itself has been quite marginal, I don't think is a big concern.
All right. Just one final question, and if you can share with us your own outlook as far as growth is concerned, what kind of a number should we be looking at for FY 2027? Also, primarily on account of whatever happens as far as our domestic demand is concerned, Neelkanth Mishra.
So our estimate for FY27 is actually much better than what the economic survey suggests. So 6.8 to 7.2 suggests a midpoint of 7%. We think 7.5% is possible. And the arguments are quite straightforward. In FY25, we did 6.5, which was when there was 80 basis points of explicit fiscal consolidation and another 0.5 percentage point of implicit, meaning off balance sheet, where the GST compensation cess was collected but not spent. On top of that, there was significant monetary tightening, and credit growth in the system shrank very sharply. In FY26, which is this fiscal year, the fiscal consolidation slowed. So from 130, we went to like 40. And on top of that, we had the monetary not being a drag. So the reported growth numbers went up. FY27, which is the next fiscal year, the fiscal consolidation slows down even more. So we only get about 20 basis points of consolidation. And on top of that, you have monetary easing. So instead of just, so credit growth actually starts to pick up. So we think 7.5% real growth is very possible. Nominal can be 10.5 plus. And so we are quite optimistic on growth going forward.
Well, that's the perfect point to end this conversation on, Neelkanth Mishra. We will, of course, all of us be looking forward to the union budget presentation and for all that is done in terms of the priority areas that the Indian economy needs. A lot of expectation, and perhaps one of the best moments macroeconomically and otherwise for a finance minister and the team of officials and advisors and all other stakeholders to be heading into budget preparation momentum. It's not just the office of the finance ministry that has changed. Hopefully, some of the solutions and prescriptions will also be forward-looking. As always, thank you very much for your time, Neelkanth Mishra. We end this conversation here, viewers, and we'll be back with more in the run-up to Budget 2027. Until then, goodbye.